There are several key considerations underlying AM Best's maintenance of a stable outlook for the U.S. P&C commercial lines segment. First and foremost, underwriting performance across the commercial and specialty lines, both during and after the global pandemic, and amidst the substantial economic and capital markets volatility of the past year, has been persistently strong. Furthermore, admitted carriers in aggregate remain disciplined about risk selection, terms and conditions, and capacity deployment, as evidenced by the continuation of strong submission flow and growth in the non-admitted or excess and surplus lines marketplace. And importantly, from the investment perspective, sharply higher fixed income reinvestment rates have begun to significantly bolster operating profitability in virtually all lines, especially long-tailed casualty lines of business. A couple of other considerations also play into our thinking and expectations with respect to pricing and reserving. Though well past its peak, pricing momentum remains positive for most classes of business, with the notable exceptions of workers' compensation and certain management liability lines, such as public companies' directors' and officers' liability. And reserve development from prior period exposures is expected to remain favorable overall for commercial lines, although at lower levels than in the last few years. However, expected reserve development from prior period exposures will vary widely by line of business. Commercial lines-focused carriers maintain strong levels of capitalization and liquidity that will enable them to navigate continued uncertainty about capital markets volatility, the growing frequency and severity of weather events, and ongoing inflationary pressures. The segment's solid financial footing reflects its generally conservative investment profile and hold-to-maturity strategy with respect to fixed income securities, as well as its moderate and generally well-reinsured catastrophe exposures, notwithstanding smaller premium rate increases and the impact of persistently elevated inflationary pressures on both property and casualty lines. Our near-term concerns for the segment focus primarily on macro-environmental considerations, including inflationary pressures, the risk environment, and pressures coming from the reinsurance sector, on which many commercial insurers depend. Firstly, economic inflation remains stubbornly elevated, despite central bank actions to moderate it, reflecting supply chain disruptions and increased commodity and labor costs, and primarily affecting loss costs in property lines. The flip side of that, in casualty lines, is social inflation, including jury awards and litigation costs, which continue to rise, affecting insurers' loss costs in casualty lines, such as general and umbrella liability, commercial auto liability, and professional and management liability classes such as directors and officers, employment practices, and cyber liability, with adverse implications for underwriting and reserve margins. Furthermore, domestic and geopolitical risks, including congressional gridlock, rising tensions with China, apparently indefinite indirect conflict with Russia over Ukraine, and a combustible situation in the Middle East have the potential to sharply heighten commercial and economic risks relevant to the U.S. P&C commercial lines segment. And finally, property reinsurance costs have risen, while coverage capacity has declined owing to storm and wildfire losses that affected most of the U.S. in 2022 and 2023. Casualty treaty reinsurers are also voicing concerns about social inflation and rate adequacy, which could lead to higher reinsurance costs and tightening terms and conditions on casualty covers. The stable outlook on the U.S. commercial segment reflects AM Best's expectation that the segment will remain profitable in aggregate and will be resilient in the face of near and longer-term challenges. The outlook also reflects the stable outlooks on the all-important commercial property and workers' compensation lines, as well as the positive outlook for the excess and surplus lines marketplace, which often diverges from other commercial segments in which it competes, driven to varying degrees by the positive and negative factors discussed in our report, as well as unique line of business specific considerations.